Warren Buffett's 3 tips to survive a recession. In some ways, the economy of the United States is improving. A promising inflation report and low unemployment have many people believing that the worst of the downturn has passed. However, many Americans are still feeling the pinch, and a recession is still a possibility. To be clear, we are not yet officially in a recession. The National Bureau of Economic Research, which is in charge of making that decision, has yet to make an official announcement. It's unclear whether we'll enter a recession later this year, but if anyone knows how to weather economic downturns, it's legendary investor Warren Buffett. Here's his advice for surviving a recession. Number 1. Keep a long-term outlook. Back in 2008, at the height of the Great Recession, Warren Buffett wrote an opinion piece for the New York Times. He explained that amid the recession, businesses will indeed suffer earnings hiccups, as they always have, but most major companies will be setting new profit records 5, 10, and 20 years from now. A long-term investment strategy involves holding investments for more than a year. This strategy includes holding assets such as bonds, stocks, ETFs, mutual funds, and others. Individuals who take a long-term approach must be disciplined and patient. This is because investors must be willing to accept some risk in exchange for greater rewards later on. Money is one of the primary advantages of a long-term investment strategy. Keeping your stocks in your portfolio for a longer period of time is more cost-effective than buying and selling frequently, because the longer you hold your investments, the fewer fees you must pay. But how much does all of this cost? You save money on taxes. Any capital gains from stock sales must be reported to the IRS. This increases your tax liability, resulting in more money out of your pocket. Remember that short-term capital gains can cost you more than long-term capital gains if you hold your stocks for a longer period of time. Then there are transaction or trading fees. The amount you pay is determined by the type of account you have and the investment firm in charge of your portfolio. You may be charged a commission or a markup, for example, where the former is deducted when you buy and sell through a broker, and markups are charged when the sale is directed through their own inventory. When you trade stocks, these fees are added to your account. This means that with each sale, your portfolio balance will decrease. Short-term volatility is normal, and there is a chance that the economy will slow and stock prices will fall in the coming months. If this occurs, your investments may lose value in the short term. Even the worst recessions, however, are only temporary, and things will improve over time. Number 2. Invest more. It can be difficult to continue investing when the future is uncertain, but now is one of the best times to do so. While the market has been recovering in recent weeks, stock prices are still well below their early year highs. That means you can stock up on high-quality stocks at a discount, potentially saving you a lot of money over time. However, you must ensure that you have a sufficient emergency fund. Always aim to have 3 to 6 months worth of living expenses in the bank, with the latter end of that range being preferable. If you are present and have extra money, you are welcome to invest it. If not, make a substantial emergency fund first. You must also ensure that you do not intend to touch your portfolio for at least 7 years. Investing in a downturn is not for the faint of heart. You may believe you are purchasing at a low price, only to see your portfolio value fall a few days later. The best way to avoid losses in a recession and come out ahead is to invest for the long term. Make a commitment to leave your money alone for at least 7 years. You must also ensure that you will not obsessively check your portfolio. When the economy is in poor shape and the stock market is volatile, you may be more inclined to check your brokerage account every day to see how your portfolio is doing. However, if you want to invest during a recession, you simply cannot. The more you check in on your investments, the more likely it is that you will panic. When you panic, you run the risk of making rash decisions, such as selling underperforming stocks, which forces you to lock in losses. According to Buffett, an important rule to remember when investing is to be fearful when others are greedy and be greedy when others are fearful. If we face a full-blown recession and stock prices fall further, that is your opportunity to be greedy and invest as much as you can afford. Number 3. Focus on quality investments. Filling your portfolio with strong long-term stocks is the best way to ensure your investments survive a recession. Not all businesses will survive difficult economic times, but healthy businesses have the best chance of achieving consistent growth despite volatility. This is especially important to remember when the stock market is down. It can be tempting to purchase risky stocks simply because they are on sale. However, even if an investment is affordable, it is still a bad investment. Stick to quality stocks that are more likely to recover from a downturn. As Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Nobody knows how the market or the economy will perform in the coming months, and there is still a chance of an official recession. Whatever happens, the right strategy and the right investments can ensure that your money is as safe as possible.